This ETF is offering weekly income with an 82% mechanical annualized run rate from the latest payment, but the autopsy table has a warning label on it. The fund's price path looks like it got shoved down an elevator shaft. So today we're opening up CWY not to cheerlead the payout, but to ask the only question that matters with funds like this. After the cash hits your account, what did the machine do to your capital? Today's specimen is the Granite Shares Yield Boost CRWV ETF, ticker CWY from Granite Shares, with data as of July 1, 2026. This is a tiny, brand-new, high-octane income ETF launched on April 14, 2026, designed for investors who want current income tied to the daily 2x leveraged price performance of CoreWeave. In plain English, this is not a sleepy dividend fund collecting checks from utilities and pipelines. It is an actively managed derivative income vehicle built around a volatile technology stock theme, then engineered to throw off cash. The fund pays weekly, charges a 1% expense ratio, and has only $1 million in assets. That size matters. Small funds can be fragile, spreads can matter more, and strategy results can look dramatic fast. Before we dissect it, this video is for research and education only. It is not financial advice, investment advice, tax advice, or legal advice. Nothing here is a recommendation to buy, sell, or hold this ETF or any other security. ETFs can lose value, including high-yield ETFs that make large cash distributions. Distribution rates can change, option strategies can behave differently in different markets, and tax treatment can vary by investor. Always verify the current prospectus, holdings, distributions, and fund documents directly from the issuer before making decisions. If this touches your real money, consult a qualified financial, tax, or legal professional who understands your situation. Here's the body on the table. CWY's latest NAV and market price are both shown at $19.44, and the fund's launch reference price was $25.46. That tells you immediately this is not a gentle income wrapper sitting calmly in the corner. It's a new, concentrated, derivatives-driven product attached to a hot technology name trying to convert volatility into weekly cash. The asset class is equity, the category is derivative income, and there is no broad index listed as the thing it tracks. That means you should not evaluate it like a plain vanilla tech ETF. You evaluate it like an income machine whose fuel is volatility, options pricing, and the behavior of the linked underlying exposure. The weekly pay schedule is the candy wrapper. The engine underneath is where the calories are hidden. The headline distribution yield is 21%. That is the number most likely to grab attention because 21% looks like a billboard screaming from the side of the highway. But with funds like this, the yield is not the same thing as profit, safety, or total return. It is a cash distribution rate based on recent payouts and price. The latest distribution was 31 cents per share, and if you mechanically annualize that latest payment, you get 82%. That does not mean investors should expect a smooth 82% experience over a full year. It means the most recent weekly payment stretched into a full-year math exercise produces a giant number. Useful? Yes, as a pulse reading. Dangerous? Also yes, if you mistake a pulse reading for a full physical. The distribution trend is already telling a story. The first 4 average payout was 47 cents, while the latest 4 average is 31 cents. That is not a rounding error, that is the early launch burst cooling down. For weekly income ETF, this matters because many investors anchor on the first few payments and mentally turn them into rent. But option-driven payouts breathe with market conditions. When volatility, positioning, and option premium are rich, the fund can distribute more. When the opportunity set changes, the cash rate can step down. The provided trend says payouts are down from the initial launch period rows to the latest 4 paid rows. So the more honest question is not, what did it pay at the party? It is, what does it keep paying after the music gets quieter? Now the capital path, net asset value is the fund's per share value after accounting for what it owns and owes. CWY's NAV return since inception is negative 24%. And the max drawdown is also negative 24%. That is the bruise. You can receive weekly cash and still watch the base you own shrink. This is why high-yield ETF analysis cannot stop at distributions. If a fund pays you out of option premium while the underlying exposure moves against it, or if distributions include return of capital, the NAV can erode. Sometimes that erosion is temporary and tied to a bad stretch. Sometimes it becomes the business model's hidden cost. Here, the path from $25.46 to $19.44 is the market's receipt. The payout did not arrive in a vacuum. It arrived while the fund's share value fell hard. Total return is where the autopsy gets fairer. Cash distributions since launch are $4.17 per share, and the simple distribution inclusive return since inception is negative 7%. That is better than looking at price alone, because investors actually receive the cash, but it is still negative. This distinction matters. A high-income ETF can make your brokerage account feel busy, with weekly deposits creating the sensation of progress, while the combined picture still lags because the share price decline is doing heavy damage. The cash softened the blow, but it did not erase it. So CWY is not just a look at the yield story. It is a measure the cash against the capital loss story. Income investors should care deeply about that gap, because spendable cash is wonderful only if the principal engine is not eating itself too quickly. Here is the machine under the hood. The listed portfolio shows United States Treasury bills 65%, US dollars 40%, plus 2 put options the fund rates for premium income. The strategy is tied to the daily 2 times leveraged price performance of CoreWeave Inc. CRWV, but instead of simply holding a pile of common stock, the fund uses an options income setup around that theme. Writing options collects premium upfront. Think of it like renting out risk. The fund gets paid today for taking on a defined exposure tomorrow. That premium helps fund the large weekly distributions. The trade-off is that options income is not magic yield mined from a cave. The fund can be exposed to sharp moves, distributions may include return of capital, upside can be structurally compromised depending on the option design, and losses can show up in NAV even while the payout keeps ringing the bell. So what should viewers watch from here? First, watch whether weekly payouts stabilize or keep sliding because the latest pattern already moved lower than the launch period. Second, watch NAV, not just price alerts and cash deposits. A high distribution with a falling base is like celebrating a paycheck while selling furniture to make rent. Third, watch fund size. With only $1 million in assets, scale, liquidity, and long-term viability deserve attention. Fourth, read the current holdings and distribution notices from Granite shares, especially for clues about option exposure and return of capital. Fifth, compare the fund's cash paid against the total account value, not against your excitement level. The forward test is simple. Can this machine convert volatility into income without grinding down too much of the investor's starting capital? CWY is a fascinating little income contraption. Weekly payments, a flashy technology-linked theme, leverage in the objective, and an options engine trying to turn volatility into cash. But the early evidence is mixed at best. The distributions are real, the damage to capital is also real. And the combined result so far is not a victory lap. For the right kind of research-minded investor, this may be worth watching as a case study in how modern option income ETFs package risk into income. For anyone chasing yield first and asking questions later, this is exactly the kind of fund that deserves a full autopsy before a dollar goes in. The verdict: interesting machine, sharp blades, handle with gloves. 2 quick things before you go. If this teardown helped you see past the headline yield, hit the like button, it genuinely helps the channel. Subscribe so the next ETF autopsy lands in your feed. And drop a comment. Which ticker should we put on the table next, and where do you think the real risk is hiding? We read everyone. Thanks for watching.